I'm conducting a weak efficient hypothesis test on 4 markets, namely Ireland, the UK, Belgium, and the Netherlands. For the purpose of this, I am using KDD methodology, which is implemented in R, which basically helps in data modeling, data mining, and analysis. The libraries that I am using for the purpose of my analysis of the time series data in R are QuantMode, Moment, Performance Analytics, T-Series, Tidyverse, Entropy, and Entropy Estimation. For the data gathering, I'm sourcing the data from a Yahoo Finance database from the period spanning from 1st January 2015 to 31st December 2019. The data set used for the purpose of analysis are the stock market index information of the respective countries. For Ireland, I have used ISEQ. For United Kingdom, I have used FTSE. For Belgium, I have used BFX, and for Netherlands, I have used AEX. The get symbol, the get symbol basically helps in retrieving the data from Yahoo Finance database. Now, in order to check for any inconsistencies in the data, I'm checking for missing values, which does it with the help of summary function. The next step is interpolation of any missing values, and for that I am using na.approx function. The next step is plotting my closing prices on a graph so that I have a visual representation of the movement of the closing prices in the 4 indexes over the period of 5 years. So here you can see that in ISEQ the last closing price is 7183.209, and with the help of the with the help of the graph you can see how the movement of the stock prices is over the period of 5 years. We can see that over a period from January 2015 to January 2016 it has moved upwards. Then in 2016 in March it has fallen, and hence these graphs just give you a quick visual representation of how the index is performing. The next step is computing the daily stock returns on the 4 indexes, and computing having a graphical representation of the movement of daily returns in order to ascertain the volatility in the returns of the 4 indexes. So here in ISEQ I could see that the last return on 2019 January 31st is a negative of 1.06 on ISEQ, and similarly you could check the closing return on these indexes on all of the markets indexes, and you can see the volatility for each of these markets with the help of these graphs. Now I'm checking the summary of the statistical summary of my data, and plotting plotting a density graph in order to see how the distribution looks like, if it's symmetrical or non-symmetrical, or if it follows a normal distribution or not. So here if I look at my statistical properties of the market return index data, I could see that in ISEQ my maximum return for the holding period is approximately 4.45%, and the minimum return seen on the indexes is a negative of 10.42. The standard deviation tells me the risk on the index, which is around 1.07%. The skewness tells me the skewness is a negative, which tells me that it has a high number of negative returns on the index over the period of 5 years. The kurtosis is quite higher than the normal distribution of the normal distribution kurtosis of 3, and it tells me that the distribution is not normal. It's asymmetrical and it's leptokurtic. Similarly, if I see at the density plot for ISEQ, I could see that it has a long tail towards the left, which tells me that it has a high number of negative returns over the period of 5 years, and it is leptokurtic, hence not following a normal distribution. To ascertain this, I am using the JAQ beta test, which basically is a test of normality. So the results from the JAQ beta test tells me that all of the markets are not normal, and they are not following a normal distribution, and hence I could say that I couldn't predict the market returns, the movement in the market returns in the future, looking at the past prices. So the p-value of the JAQ beta test on all of the markets is greater than my level of significance of 1%, and hence I could accept the null hypothesis of JAQ beta test of non-normality. The next test that I am doing is the correlation, is to find the correlation between the markets, and I'm using table.correlation function in order to see the correlation value on between the markets. Now, to have a graphical representation of how the correlation looks like amongst these markets, I could see that all of the markets have a strong and a positive and significant correlation, with ISEQ having the highest correlation with BFX. So I could say that if one market is if Ireland market is bullish, I could ascertain that the Belgium market would be bullish, and vice versa. The next step is to check for the weak form of efficiency in these markets, and for that purpose, the first test that I am doing is the unit root test. The unit root test basically tests the stationarity in the time series data. The null hypothesis is that the data is non-stationary, and the alternative hypothesis is that the data is stationary. So I am using augmented Dickey-Fuller test. If I run the test on all of the markets, I could see that I'm using the lag order of 15, and my level of significance is 1% here. So I can see that the p-value is greater than my level of significance for all of the markets, and hence I could say, that the unit root exists in the data, and hence the data is non-stationary. The next test is the serial correlation test. Basically, a L-Jung box test checks for any serial correlationship in the variables, and it says that if it has a serial correlation, it tells me that I could predict the values at certain lags, and I could make the future predictions looking at the serial correlation within the variables. So the first test is on the Ireland market index, and the p-values is significantly higher than my level of significance of 1%, and hence the Ireland market rejects the null hypothesis of non-serial correlationship. For FTSE, I could see that the p-value is smaller than my the p-value is significantly higher than my level of significance of 1%, and hence FTSE is following a random walk. It is not following a serial correlationship. For BFX, again, I see that the p-value is smaller than the level of significance, and I could reject the null hypothesis of non-serial correlationship. For AEX, again, it is following a random walk, as the p-value is smaller than my as a p-value is greater than the level of significance. So all in all, the Lung box test tells me that Ireland and Belgium are not following a random walk, since at lag 1, 4, and lag 5, I could ascertain the prices at lag 1, 4, and 5, and hence they have a serial correlationship. United Kingdoms and Netherlands are following a random walk. The next test is the run test, which basically tells me the changes in the sequences in the variables of the time series. The run test basically determines if the time series is following a random walk or not. So the null hypothesis is that the time series is following a normal walk. It is following a random walk, and the alternative hypothesis is that it is not. So the results from the run test, the p-values are all greater than the level of significance of 1%, and hence I could ascertain from run test that all of the markets are in the weak form of efficiency. The last test is the Shannon information test, which basically tests the markets for their market information efficiency. From the results, I could say that Belgium and Netherlands are in the highest efficiency form of on market information, with FTSE being in the last and FNISEQ Ireland being in the third position. This we can ascertain looking at the entropy score on the four markets. So hence, all in all, we can conclude that all of the four markets are following a weak form of efficiency, and we cannot predict the future prices looking at the past information. And we can also say that in these markets, we could have a passive portfolio management investment strategy would be better than an active portfolio investment strategy. Thank you so much.